Hi, welcome to Random Rogers Big Picture for the week of January 14th. A couple of interesting things on the docket here. One is about the macro shares, and two, someone asked for my take on energy. So here we go. First, the macro shares. I started to get a few days ago a couple of different emails or comments left on my blog or emails to various addresses asking what's going on with the macro shares. They are straying away from their NAV price in a way that I've not seen other exchange-traded funds do. The up shares, the UCR, Kramer stop, the UCR has a 12.7% premium. The down shares, the DCR, has a 5.5% discount to NAV. So I said on the blog that I emailed into someone, and someone gave me a call back and found out, and this is really very interesting stuff in an incredibly nerdy sort of way. There is an issue with the fact that the actual oil market is in a state of contango. The idea is something along these lines. If the oil market is in contango, and if the macro shares don't price in that contango, for people that have access to both markets, there is a free arbitrage that would be huge. This is something that, based on my phone call with Claymore, they apparently did not see it coming. I know I didn't see it coming. I didn't think about it. And they wanted me to stress, and I promised I would, but I think this is obvious. They have no exposure to energy futures of any sort. They are replicating it with the value of the two funds and the relationship between the two. They're replicating oil exposure, but since there is no futures in either product, in theory, there should be no contango or backwardation issue, but there essentially is, and this is kind of a type of market efficiency that they apparently did not see coming. So this is fascinating stuff. That's part of the problem. Another part of the problem, which is very detailed and not completely open to public information, has to do with distribution of the product. There are various authorized participants, you know that term. There are also specialists involved, and somehow the distribution process needs to be improved. They're taking steps to improve it, or steps they feel will improve it, and we'll just have to see over the next few weeks, or maybe even a little longer, if what they're doing for distribution actually works or not. Fair enough, but they think that some portion of the issue is also distribution. A third thing is the supply and the demand between the two products. There basically has to be a balance between the two, such that the NAVs add up to $120. If you go to Claymore, or if you go to macroshares.com, it will take you right to a page that shows the NAVs, and you'll see that they are very close to where they need to be. The market prices are way off, but the NAVs are going to add up to 120, give or take a few pennies, and so they're doing that, but there is a lot more demand and a lot more volume for the up shares, and you can see this in the volume of the product. So three problems: contango, distribution, and supply-demand imbalances between the two. At this point, they're trying to figure out how much of the current pricing problem to attribute to contango, how much to contribute to distribution, how much to attribute to the supply-demand dynamic between the two. This is not something that they've worked out yet. All three, they think, contribute to the issue. They're taking steps to try to rectify at least one of them right away, and they're studying how to fix the other. I asked if there were other macro shares on the drawing board, and if so, what this little event does to whether or not they bring them or not. And the short answer was there are macro shares in the works. They do want to solve this problem, though, before any of them get listed. I didn't ask what the other ones were, and they didn't tell me. There's certain things that they're just not going to tell you, and despite what you see on TV, if you know they're not going to give you an answer, it's a waste of everybody's time for me to ask the question that I know I won't get an answer to. So I tried to ask questions that I would get answers to. But this is fascinating stuff. Again, what's fascinating is this market efficiency that sort of overtook the product. Because, again, without pricing in contango one way or another, it would be free money between the two, and that is taken away. Pretty neat stuff. Someone asked me what I think about what's going on with energy. Well, this is a tough one. It is spiking down, and based on the action that we're seeing price-wise and how big the moves have been every day, Friday notwithstanding, it clearly is a rotation of some sort or a panic of some sort of capital flow that probably doesn't have much to do with fundamentals. I would surmise that if the real price for oil should be $50, and I'm making that number up just for example's sake, that we might see this move take it down below 50. The likelihood that it stops right at what should be fair value would be pretty surprising, but you never know. As far as how I'm playing it, well, quite a while ago, and I can look this up and link to it, but I disclosed on the blog switching out of British Petroleum and into the Wisdom Tree Energy Fund, which is DKA. There were a couple of ideas behind that. I think I only expressed one idea, but the one that I expressed was the way British Petroleum was acting, and I think at the time it had either a 67 handle on it or a 68 handle, I don't recall which. But I wasn't thrilled with the way it was acting. I didn't think I would get any extra benefit by holding on to it for the short term, and the yield of DKA was almost the same. It was a 325 implied yield versus 350 when I sold British Petroleum. So giving up 25 basis points, I took single stock risk off the table, and I was thinking temporarily, which maybe is 6 months or 9 months, but we'll see how long I stick with the DKA. Candidly, I'm not sure. BP has had more problems than I would have expected. Friday's rally on the John Brown resignation notwithstanding, the share price has done worse than I think I would have imagined. So it turned out to be a good trade, but the kind of the bigger issue was oil was kind of looking a little tired, and I took a little volatility by switching from a common stock to an ETF. I took a little bit of volatility out of the sector, which helps dampen volatility of the whole sector. Some longtime readers might recall that I own Statoil, which is a fairly volatile name because of how exposed it is, or unhedged maybe is a better way to think of it, to the price of oil. Most clients then from there either have an oil sands stock or a Chinese stock or a domestic refiner, which is itself a pretty hot potato at times. But so that little switch helped dampen the volatility, and it's probably helped me out a little bit in the last couple of months in the portfolio. That's looking backwards. Looking forward, what are you looking for? Are you looking for a trade, or are you looking to build a position in a portfolio? As far as trading, right now I'm probably equal weight the sector, maybe a tad under, but it's really, I'm not making any big position move with it. When the blog first started and up through quite recently, I was overweight the sector, and I did take some exposure off the table a couple of times. Back in the spring, I took some exposure off, and I blogged about this, but I took some out of Statoil. I reduced that by a decent amount in April 24th or 25th, something like that, of last year. That took off some exposure. And then by reducing the volatility of the exposure, that in a way, kind of like an options delta-ish way, reduced yet more net exposure to it with the DKA purchase. If you're looking for a trade, I'm probably not so great at giving you much input there. Clearly, things are oversold. I don't know on Friday how much of the oversold condition was worked off. Probably not that much. I mean, the decline down from 61 to, I think it closed in the 52s on Friday. That is a very swift move, and I would not expect directionally that to hold without going up and doing something on the upside first. But I'm not betting money toward that end. As you know from reading the site, or hopefully reading the site, that I don't try to make short-term bets, certainly not with client money. That's for darn sure. And occasionally I'll make a short-term bet personally, but with regard to energy, I haven't. I don't feel that I need to. I'm fairly well exposed. I disclosed buying I think I bought it for 4 clients and myself, a Russian oil stock. That was Lukoil. I bought it at I'm pretty sure the price was $79.35. That was a while ago. It went zooming up to about 92 or maybe 94. I tried a limit order that did not work to get out. The last I looked, it was at 80. Maybe it's lower than that. I don't really care. It's a long-term thing, but I would not be surprised if Lukoil printed 70, down $9 from where I bought it. Wouldn't surprise me in the least. That goes with the territory of some of these things, and circles back to something I've been talking about repeatedly. Certain things you have to think long-term, and that's what I'm doing. Take it easy. And, well, the dogs are telling me to wrap it up, so I've got to wrap it up. Have a good weekend, and see you later.